Hello, my name is Yao. I'm the Chief Investment Officer at Astrea. Thank you for taking the time to join us to understand the Astra 7 transaction. Astra 7 is offering three classes of PE bonds, Class A1, Class A2, and Class B. This table here shows an overview of all three classes with their respective issuance sizes, expected credit ratings from Fitch and/or S&P, interest rates, scheduled call dates, and maturity dates. All the interest rates for the different classes of bonds have been set and priced by institutional and accredited investors through a competitive book building process. A portion of Class A1 bonds and Class B bonds are offered to retail investors in Singapore through the public offering. The remaining bonds were distributed to accredited and institutional investors through a placement offering. The bonds are backed by cash flows from a diversified quality portfolio of private equity funds. Class A1 bonds are expected to be rated A+ by both Fitch and S&P, while the Class B bonds are expected to be rated BBB+ by Fitch. These are both investment-grade ratings. Both Class A1 bonds and Class B bonds will be listed and traded on the SGX main board. For the public offer of Class A1 bonds for retail investors, the bonds have a fixed interest rate per annum payable semi-annually. The Class A1 bonds have a legal maturity of 10 years with a mandatory call at the end of year 5 if conditions are met. Their scheduled call date is in 2027, the 5th anniversary of the bond's issuance. If the Class A1 bonds are not redeemed on their scheduled call date, there will be a one-time 1% step-up in the interest rate. I'm pleased to announce that for the first time, retail investors will be able to subscribe for Class B bonds. For the public offer of Class B bonds for retail investors, the bonds have a fixed interest rate per annum payable semi-annually. The Class B bonds have a legal maturity of 10 years with a mandatory call at the end of year 6 if conditions are met. Their scheduled call date is in 2028, the 6th anniversary of the bond's issuance. If the Class B bonds are not redeemed on their scheduled call date, there will also be a one-time 1% step-up in the interest rate. Here, you can see the capital structure of Astra 7. Class A1 and A2 are pari passu, which means that they rank equally in the capital structure. They also rank senior to the Class B bonds. Class B bonds rank junior to and will be paid after the Class A bonds. Hence, Class B bonds have a higher risk profile as compared to the Class A1 bonds. As mentioned earlier, in addition to the Class A1 bonds, which have been available for retail investors since Astrea 4, Class B bonds are now also offered to retail investors for the first time. Each tranche is rated independently by international rating agencies Fitch and/or S&P, and the ratings reflect the credit quality of each tranche of the bonds. It is important for you to note that Class A1 bonds are issued in Singapore dollars, while Class B bonds are issued in US dollars. This means that Class B bond holders whose investment currency is not in US dollars may be subject to exchange rate fluctuations between their investment currency and the US dollar. Astra 7 bonds are issued at a conservative LTV ratio of below 40%. This means the portfolio value is more than twice the amount of the bonds issued. If there is an event that significantly impacts portfolio value and the ability of the portfolio to generate cash to support the bonds, Class B bonds, being the most junior tranche of the bonds, will be affected first. With the LTV ratio below 40%, this means that the Astra portfolio will need to lose more than 60% of its value before Class B bond holders are impacted. As a Class A bonds rank senior to Class B bonds, the portfolio will need to lose a greater amount of value at 70% before Class A bondholders are impacted. Here, I would like to share a little about the transaction structure. The transaction is managed by Astrea and the cash flows are administered by Sun. Sun is an established fund administrator and its parent is listed on the London Stock Exchange. On the right are the other counterparties involved in the transaction. We have DBS Bank acting as credit facility provider. This credit facility can be drawn to pay capital calls issued by the underlying PE funds or to pay interest on the bonds in case of cash flow shortfalls. Other counterparties include the hedge providers, as well as the bond trustee and the security trustee. Here, allow me to explain in simple conceptual terms on how Astra 7 PE bonds are backed by cash flows from investments in 38 PE funds. An Astra 7 subsidiary owns interest in the 38 PE funds. Altogether, these funds have invested in a total of 982 investee companies at launch. When investments in these companies are sold by the PE fund managers, the cash is distributed to Astrea 7. The cash can be used to fund capital calls at any time, and at the end of every 6 months, any remaining cash must flow through a waterfall called priority of payments. How the cash can be used is strictly governed by this waterfall. I will now share a simple conceptual illustration of how the priority of payments work. Astra 7 pays out every 6 months. Clauses 1 to 4 represents key fees and expenses necessary to run the structure. In Clause 1, available cash flow is used to pay for any taxes and administrative expenses up to a cap of $0.9 million per distribution period. In Clause 2, payments under the hedging arrangements. In Clause 3, payments are made for the management fees. In Clause 4, payments are made to pay commitment fees for the credit facilities, as well as any interest and principal if the facility is drawn. Clauses 5 and 6 represents interest payments to all bondholders, with Class A bondholders ranking ahead of Class B bondholders. Clauses 7 to 10 represents cash used for reserves and principal repayments. If the issuer sells any of the PE fund investments, Clause 7 ensures that the net cash proceeds from any sale after fulfilling senior obligations can only be used to fund the reserves account or to repay any outstanding bonds. There are separate reserves accounts for Class A bonds and Class B bonds respectively. Clause 8 allows sufficient cash to be built up in the Class A reserves accounts to redeem Class A bonds. Regular reserves amount equivalent to 10% of the principal amount of the Class A bonds are scheduled to be set aside every 6 months for the eventual repayment of the Class A bonds at the end of year 5. If at any period the scheduled amounts are not fully reserved, the issuer has to make good on any outstanding amount in the subsequent period before continuing with the regular reserve schedule. Once Class A bonds have been fully redeemed or reserved, Class B bonds will begin reserving, with 90% of the available cash then flowing into the Class B reserves accounts. Clause 10 is a structural safeguard. This is where the maximum loan-to-value or LTV ratio is measured to ensure there are sufficient assets remaining in the structure as buffer for bondholders. If the 50% LTV ratio is exceeded, the sponsor cannot receive any cash unless more cash is set aside in the reserve accounts or bonds are repaid such that the LTV ratios falls below 50%. Clauses 11 and 12 takes care of any remaining expenses and cost. And finally, we have clause 13 as payment to the equity investor. Here, I would like to share what are the key differences between Class A1 bonds and Class B bonds other than their differences in ranking. Class A1 is issued in Sing dollars, while Class B is issued in US dollars. Class A1 has a slightly earlier call date as compared to Class B. Both A1 and Class B are rated independently by credit rating agencies. Class A1 is expected to be rated A+ by both Fitch and S&P, while Class B is expected to be rated BBB+ by Fitch. Class A1 bonds and Class B bonds have a different coupon rate per annum as shown on this slide, both of which are payable semi-annually. Our bonds have three key credit strengths that I would like to highlight. 1. The bonds are backed by cash flows from a diversified quality portfolio of PE funds. 2. With an over-collateralized capital structure where the portfolio value is more than twice the amount of the bonds issued, the LTV ratio is below 40%. 3. There are several structural safeguards to ensure bond interest and principal repayment to be paid on time. Let's go through these in more details. The Astrea 7 portfolio is geographically diverse, with a majority in the US and the balance in Europe and Asia. US is the most developed PE market, while Europe and Asia are fast-growing and provide diversification. The Astrea 7 portfolio is strategically focused, with over 75% of the portfolio comprising of buyout funds and the remainder in growth funds. There is no single name concentration in any funds or managers. The portfolio is diversified across vintages. The portfolio is mature and it is cash generative. The portfolio comprises of 982 investee companies across many different industry sectors. The largest investment is less than 1.5% of the portfolio NAV, showing how well diversified the portfolio is, with no single company concentration. The capital structure is over-collateralized, and the total amount of bonds issued represents less than 40% of the portfolio value. This means the value of assets is more than twice the value of the bonds issued. Another credit strength is the provision of structural safeguards. First, there are reserves accounts. Cash is reserved into the Class A reserve accounts every 6 months to build up sufficient cash to redeem Class A bonds. Once Class A bonds have been fully redeemed or reserved, Class B bonds will begin reserving with 90% of the available cash then flowing into the Class B reserves accounts. Second, there is a maximum LTV ratio mechanism. If the LTV exceeds 50%, cash cannot flow to the sponsor and must be used to deliver the structure by either accelerating payments to the reserves accounts or by repaying the outstanding bonds. Third, there is a credit facility provided by DBS Bank. In the event of cash flow shortfalls, the credit facility can be drawn to fund certain expenses, including management fees, interest expenses, and capital costs. However, the credit facility cannot be used to repay the bond principal. This concludes the overview of Astrea 7. Thank you.